President Sir and all the office bearers of CTC. It's always a pleasure to come back and address the members. There's always a learning back, which I take back home in terms of where the gap still lies. It's a big challenge that one portion of the topic has been dwelt by very senior members of the profession at length, and therefore it's going to be extremely difficult to add more value to what they have written, deliberated, and produced. But we'll certainly spend some thoughts around both the significant amendments. And before that, for all Zubin and all my Parsi friends, very happy New Year and Navroz Mubarak to all of you all. At the outset, no presentation is done without the help of the colleagues from the organization. And in specific, I would like to acknowledge the contribution from Bhavin Kapadia, my partner, and Priya and Sheetal, who have helped produce this presentation, and compliments to themselves, to them. Specifically, if we look at the changes, and then just an opening remarks, and these are my personal view. I do not say these are my firm's view, but these are my personal view. The host of the amendments, both to CARO and to Schedule 3 all across the division, to some extent does reflect that Business India is suffering from a trust deficit. While Zubin did take us through from the point of view of the changes from Mao CARO to CARO and its journey, but this certainly is pointing towards the fact that the regulators wants to know more. They want to know what is behind the curtain, and they are not happy with the financial statement per se. And that obviously leads to the fact that the people, the government, the capitalists are all in a triangle of trust. So what's going to happen is that the implementation challenge, both for the preparers and auditors, are going to be humongous. It's going to give sleepless night. And if I may borrow words of Viraf, it's going to be overwhelming. That's for sure. But it also takes to another flip side, that too much of information without explanation can also be dangerous. Because finally, as we will run through some of the slides, if you give information but does not give what that information means, then it can be read in a very, very different context. And so therefore, this entire lecture and the book which has been released also on CARO 2020, and I would definitely believe that this should be marketed not amongst the auditing professionals, but be marketed amongst the preparers as well, because they must know what is the auditors are going to report upon, and what is their duty towards the giving the information, so that the auditors are able to deal with the subject. So that would be my, I can see from the cover page, and I'm told that Tejas would also have it delivered soon. So I will certainly look with it. And with this, I have been given round about an hour and 30 minutes. Both the topics should probably consume around about an hour and 20 minutes, but I'm happy to take questions as they come along, or I'm happy to take the questions as they after the last 15-20 minutes. That's what I would be. And Tejas, would that be good?
Yeah.
Or would you like me to?
Yes, sir. It's fine.
Thank you. So with your permission, I would begin with my session, and I hope the slides are fully visible, right? So what are we covering this evening? We are covering the recent amendments in Companies Act 2013, the Schedule 3, which is both Division 1, 2, 3, while a lot of commonality is there, and then obviously the CARO 2020. So change means that what was before wasn't perfect. People want things to be better. And I guess this is the line of thinking with which the Ministry of Corporate Affairs have moved forward. So what are the slides broken up into the amendments and the key changes to CARO 2020? So what is from a, if we were to decipher this entire changes, right? What does that mean from the stakeholder? It means obviously there is transparency, there is an investor confidence, the stakeholder satisfaction, if I may want to say, the accountability. Obviously, there is accountability all across. And obviously, there are early warning signs if one is able to read the content of what has been provided in terms of where the specific reporting entity is going. I mean, so this can be a kind of a stakeholder's delight if I was to ask. What does it mean for the company and auditor? It definitely means extensive disclosures, and in some of the cases it will go back to the yesteryears, and it may look.
Sandeep, the slides are not moving.
Oh, they're not moving?
Yeah, I think at least I am not able to see it moving.
Am I only on the first slide?
Yes, sir. Yes, sir. It is not moving.
1 second.
Sandeep, you can put the presentation mode actually.
Yeah, presentation mode is one, and then you can also see whether it is moving or not. Try it once.
My side, it is moving. So
Yeah. That problem does come. I think you'll have to stop sharing and again reshare it.
Okay, thanks. Thank you for that inputs. What slide am I on?
Just now you're on the first slide. Just go down. Yeah, now it has moved. So if you can just on the right hand side, if you can do the slideshow and see whether it is moving.
Yeah. 1 second.
Otherwise, this is fine.
This is fine. Okay. I'm on a slideshow, but 1 second. Let me close the other one. I think there are 2 slides which are going on. Murphy's Law, I guess. Is the slide on?
No, sir.
Not as yet. 1 second.
It's coming now. Yeah, it's there.
Yeah.
Is that on a full slide?
No, it is not. No.
Not first.
Is that on a full slide now?
No, it's not. I think it will not happen. That's some technical glitch. So you just see if it is moving at least the slides.
Is this moving?
Oh.
So I'll have to then probably I will not go on the full slide.
Don't go to full slide. It doesn't move on full slide.
Yeah, it's not moving on a full slide. So I will have to probably take this.
Yeah. No.
Sorry.
Yeah, this is fine.
Sorry. So I did speak about this slide about the change, and I did talk about that the presentation is into 2 portions, and I did share about the aspect on transparency, investor confidence, stakeholder satisfaction, accountability, and earning warning signs from a stakeholder perspective. And I was at this slide on the point that what is a major impact for the reporting enterprise and for the auditors? Obviously, it means extensive disclosure, enhanced auditor reporting, comparative for all disclosures. It obviously will demand a lot of IT infrastructure and robust systems and processes, because the time which you take for doing the audit and the time which you will take for final reporting, probably, both will go hand in hand. And therefore, I don't think one can have a situation that on a time management basis, based upon the various changes, one can say that you can finish your audit and then you can commence the part of reporting. That is not going to happen. Both of them will have to go hand in hand, is what the whole changes are all about. And as we speak now, and as everybody said that it's, and I could see some chat box as well, that it's a timely reporting, and having gone through all the changes, and we are also currently in the midst of drafting the guidance note for all the 3 divisions. The time for all of us, I think, has already taken much time earlier, and therefore, there's no way in which we can afford to lose even 1 minute in terms of preparing for the next year, while the current year's work for March 21 is also being handled. So there will have to be a lot of dedicated team who looks forward, like CTC today, in spite of the various aspects, they'll decide that they will take on a most relevant topic for the year, which is passing by. And this is what I also feel, that all of us will have to prepare, and the team will have to prepare, and there will have to be a continuous dialogue. So let's look at from the Schedule 3 broad amendments, right? So Division 1, 2, and 3, which is to do with companies, Indian GAAP, the Ind AS, and the NBFC Ind AS. Mainly, what is it doing? It is trying to improve the transparency and usefulness in the financial analysis. Obviously, the closed group related disclosures are there. It is also trying to look at where are you raising money and where are you spending money. They are interested in looking at the compliance with the laws and disclosure thereof, and there are other incidental challenges. In specifically, what are the, if I was to look at from a transparency, so what are they trying to look at? Trade payables, trade receivables, revaluation fair value, title deeds, CWIP intangibles under development, and financial ratios. And in this, one of the thought which I have is that the amendment, and that was a matter of debate when it came out on the last week of March, whether will it apply immediately, will it apply subsequently, and today it says obviously 1/4/2021, and the question is going to be whether is it going to be for year ending on or after 1st April 21, is it going to be year commencing on or after 1st April 21. In both the scenarios, one big challenge is about the fact that if they say year beginning on or after 1st April 21, then all those calendar year reporting, their report under schedule will go only to December 2022. And I don't think the government is looking for a difference of over 9 months before they see this result. And if they say that this applies for accounting year closing on or after 1st April 21, then which would mean that for all these enterprises, they will have to go back to 9 months in the earlier period. It's not a very easy role. And at this point of time, while the MCA obviously is not giving its mind, but there will have to be a better clarity on the applicability of the Schedule 3. I personally have no definitive view. That my original view always was that the Schedule 3 amendments gets impacted from the time it is released in the Gazette. And therefore, it is not a period-based schedule. It will apply from the time it is officially gazetted. But the overall thinking amongst the professional circle was that, look, on 27th, it could not have intended to be applied for the year ending 31st March 21. Be that so, it would be interesting to keep this one part of the amendment at the back of the mind. And obviously, the questions are about for all the interim accounts as well. And as far as the console is concerned, fortunately, there is only subsidiary data will be there, the ratios will be there. So the CFS is also going to be another big set of challenge where you have NBFCs as your component. How in the whole schedule at a CFS level, it's going to be extremely important. And that's the point which I was driving at, that each of these challenges will have to be seen. The movie is a 3-hour movie, but the time which it will take and the number of edits and cuts and questions and, deliberations and difference of opinion amongst, the auditing fraternity, amongst your team members with client, these are, the permutation and combinations can be quite many. But one of the major, before I get into the specific amendments, what I thought I would like to, share with the members is that what are the common challenges which some of this transparency is going to lead to. So for a minute, take an example that during 21-22 or even earlier, you have done a business combination, you have acquired businesses, or there have been some mergers or there have been demergers. I will, for a minute, I will take the common control enterprises. I will not take too much of a challenge because the information has to be there, otherwise the common control cannot get established. But there is a business combination or there is an asset acquisition. Now you take in point that you have done your diligence, you have looked at your financials, you have put up a price to the assets and liabilities, and you have fair valued some of the items, but you certainly have not gone ahead and taken every line item, because business combination by meaning is not a line by line acquisition. And today the question would be that when you pick up a business combination and fast forward March 22, you would, and obviously in business combination, it is not necessary that you will get the entire software of the selling enterprises. Maybe in some cases it is possible, but most of the time they will give you some data which you will have to probably work through. And there may be CWIPs which they would have carried forward, and you have taken over in the same status in which it is, and you would have probably valued the CWIP or intangibles under development at a particular price. How is the preparer and the auditor going to be giving this information on aging? If you say that this came into existence in my books only in 21-22, and therefore my time starts from 21-22, obviously the stakeholders are not happy because they really don't know what is the aging of what you have bought over. If you have taken a CWIP and you have done the adjustment, it may have been built over a period of time. There may be a time overrun, there may be a cost overrun, but finally their time overrun and cost overrun has nothing to do with the acquirer. Yes, I see somebody raising the hand. Is there a question for me at this point of time?
I think so. You can carry on. We can take it.
Okay. Okay. Right. So how is the acquirer going to deal with this information, and how, and you do not want to, as a preparer, you don't want to say I don't have this information, because then somebody will say that what have you acquired, right? So this is one thought which I would like to leave behind all those where their client are in the stages of acquisition happening. The second part of it, what I thought, and it was going to be very interesting also for public sector undertakings when they're going to give this information on CWIP, because currently they do share notes around the CWIP. I mean, like pick up NTPC, right? NTPC is probably at this point of time, March 21, the CWIP is to the tune of some 75,000 crores plus. And 75,000 crores of CWIP for one singular entity, which may have been, these are all long-term gestation period built over various items. What is the granular level till which they go? And I'm picking on to the words of Zubin, that they are certainly overwhelming. I mean, like, finally, the task will have to be done rightfully and in all fairness. But the question also is going to be that it is not going to be very easy. So this is what I thought was my starting point in terms of, and this will cut across whether it's a division 1 or division 2 or 3, because I mean, like, okay, you don't have a business combination in division but 1, but you certainly have an asset acquisition. Specifically for trade payables. So obviously, what is the government looking for? They're looking for trade payables which are due for payment within 1 year, 1 to 2, 2 to 3, and more than 3 years. And they're looking at the aging schedule, and the unbilled dues shall be disclosed separately. Now, and there you have MSME, you have others, you have disputed dues. Now, MSME is never a challenge because the Act defines what a dispute is about, right? So the period of, if it is maximum what you can give is 45 days, if not 15 days. And if there is a dispute, from the time the dispute is resolved. So I believe that as far as the MSME is concerned, dispute is a well understood, well appreciated aspect. But the big question which is going to happen is that what does a disputed due in others mean? Disputed dues in statutory dues is also known. Only merely putting up a letter does not mean that you are disputing. It's merely a representation. But when it comes to other dues, what does a dispute mean? Now, disputes, whether do you go to the Indian Contract Act? Do you go by the Information Technology Act, which says that even a dispute over email is a dispute? Do you go to the Sale of Goods Act? Do you go back to the generally understood terminology of a dispute? Even a verbal communication is a dispute as far as the courts are concerned. And therefore, it can be legal, it can be oral, it can be in writing, it can be through emails, it can be through correspondence. And the questions are going to be that what is the degree of auditing is capable before one says that this is disputed. And I am disputing it because because the quality was not right, whether it was not timely delivered, there were more rejections than what was permitted. It is still subject matter of discussion. There can be, we have seen that during the course of the circularization of the payables and receivables, you get a lot of questions around the reconciliation matter. And it is going to be very interesting to say that up to what executive the auditing fraternity will say it is disputed. And once the bucket from your payables becomes a disputed, I'm sure everybody is interested in understanding that if you have 1,000 rupees of payable and out of which 500 is under disputed, and that also is less than 1 year, everybody is interested in knowing that whether does this company really buy with a view not to pay, or is it that this is a very transparent company which is able to give information and will give the detail of what do they mean by dispute. And therefore, in my opening remarks, I mentioned that information without explanation can lead to various different challenges. What will it mean in terms of, all those who are using ERP packages, and everybody is familiar with the invoice to receive module in the SAP and the all other Oracle and other modules. And the question is going to be that what is parked under ITR now will also have to be closed because it needs to get bucketed quickly. What was happening so far was that invoice to receive was being looked from the compliances of your TDS if there was any liability. Rest of it was being clubbed into the respective point. But if one has to comply with this, your virtual invoice to receive ledger will have to be closer to zero. So this is one part of the trade payables is what I would share my thoughts on. We are also at the guidance level, we are obviously looking at what the words disputes are. For the preparers, obviously there will have to be a lot of system modification for the aging data. There is going to be, because unbilled portion, that liability, the format has not been mentioned. It is only saying that the it shall be disclosed separately. Now, will it be disclosed in the same format or will it be disclosed in a different format? Now, this is something which will also evolve. There may be a very simplistic view in absence of a format. It's just a singular line. Somebody says that no, if we want to go that extra mile, let's give that in the format in which it is required. Now, you may have a question that whether is it already due for payment or not due for payment, and what happens if there are verbal communication around postponement. I mean, like we've all gone through the COVID times and we all know that there have been extension, and those extensions may not necessarily may have been in writing. So that's going to be another set of questions, that what is due for payment and what happens when there are changes which are happening, whether are minutes of meeting good enough? Do I need an evidentiary value from the supplier to say that, okay, this time is extended. In CARO for loans, we were always, coming back and saying that unless you have an evidence in value, you will not move the liquidity bucket from the month in which it is falling due, because you don't have a right of deferment. And I think that would be true for the trade payables as well, but many industries, maybe at Schedule 1 level as well, for Division 1, where you have different sizes of companies, there may not be a very formal credit period which has been either documented in the purchase order or in your supplier's invoice. So yes, there are going, so the question is going to be that if one is going to do an interim audit, one will have to start looking at it, that if I was to close this as of 30th September, what are my challenges? And then fast forward each of the items as the quarter goes by is what I would believe that most of the preparers and the auditors will move forward. Trade receivable on the IGAP side, obviously they are looking for good, doubtful, undisputed, considered good, and considered doubtful. And this is again the flip side of what we looked at on the trade payable side. It's the same flip, that considered undisputed. I'm saying it is undisputed. Opposite side may be that they will put you the same test, and therefore while for provisioning purposes, all these factors are considered. So it's not something which is new. I think as auditors, each of these steps have been taken while doing the audit. But the question is now what you are doing is also needs to be bucketed and then presented. I think that is where the aspect is flowing. And then, they are looking at on the same lines, whereas there they have said up to 1 year. Here they've continued with less than 6 months and 1 year, as the internal breakup is something which they have already considered. The undues, as we know that as far as we may have services for which either there is a billing schedule is there, and unless you achieve that threshold level, you are not able to bill, and you have recognized your billing in progress. So that in the same bucket for Schedule 2, for Division 2 and 3, unbilled revenues, because you take that into consideration for the purposes of your ECL, I guess there is a little better, lower amount of efforts. But for the Division 1, I definitely would believe that in some of this service industry and others, this will cause some amount of a challenge and will have to be addressed. I'm sorry if I'm, constantly using the word challenges. I'm only trying to highlight the point that this is not going to, this book, I mean, like the chamber, spoke about how closely it was monitored, spoken, and it has gone through only 4 people or 5 people and a coordinator and a conceptualization. But annual report is going to be work of too many people. So pardon me if you find me, echoing the voice on challenges again and again, but it is only to highlight the point that this movie is not going to get released with ease. So if we look at trade receivables, or as far as the Division 2 and Division 3 is concerned, I mean, like this has been a matter of always a big challenge, that if you are following a simplified approach, then you don't necessarily track the credit risk at inception, and therefore you don't even monitor the increase in credit risk. But this is nonetheless a format, and therefore the guidance was given around that how does one handle the, in a simplified approach. As far as those who are not following simplified approach, this is a cakewalk as far as the what is the credit impaired or enhanced credit risk from inception is concerned. But the fact of the matter, the flip side of it is that ECL model necessarily means that 100 is not good, and therefore between considered good is always, because sum total of undisputed and disputed has to become good, but good itself is a carve out. and because you will not receive 100 to the extent of your ACL provisioning, and therefore I have always, felt that the government, after 2-3 years of experience, could have made this portion for Ind AS companies little more meaningful, considering our 109 disclosure. However, the same questions about the the breakup is again going to be available, and the matrix is going to be interesting to see as to how each of this bucket in kind of a matrix is going to look like, because the idea is that when you give information, that information should be capable of being used, understood, and put to use. I think it is also going to be important. So the formats of how this will evolve is going to be another set of work, and I would if, the chamber may also consider, may not be the full, but if that falls under the chamber's domain, is to also look at, because I heard on CARO that we have given the practical examples, and these are also going to be a lot of practical examples which are going to be required. If we look at from a perspective of revaluation or the fair value of the PPE, and the question is about both at the PPE and the intangibles, and the if there is a change greater than 10% of the net carrying value of each class. As we know that this essentially will apply where there is a revaluation model, and this is not going to be very difficult, but the question which is still going to happen is that because we are going to look at the net carrying value of each of the classes, so we will have to go based upon the first, what was the net carrying value, and then look at what is the revaluation, and then look at how the difference is going to be, what is that change. And of course, I guess there will have to be, because this 10% threshold has a meaning, and that meaning will have to be with reference to explanation. And as we know that the in specific, the companies have management and accounting rules have, and the registered valuers, the rules are also there. And the basis of fair value of investment property will have to be through a registered valuer. And you would see one part of it is that in many disclosures, the companies would take a circle rate given by the stamp duty office as a fair value. But certainly that is not the most optimal answer, because your circle rate did not be a fair value. And therefore, for all those, either in terms of the disclosure, because for investment property, India has taken and carve out, and therefore we don't have a revaluation model, but that I guess is already under a great consideration. For the InvITs and REITs, also therefore, but well, InvITs and REITs, this will not apply to them, but there also they had to look the disclosure. I'm told the insurance companies are insisting that the revaluation model be introduced and not have a carve out, and I guess that would be one part of it. But in the meantime, it is going to be an interesting to see for those who have used circle rate, how the registered valuer and the explanation around the various inputs, because that is also a requirement of on one hand, or Ind AS 40 also, that's a requirement. And for PPE, while one will have to be little more disclosing that this 10%, why is this 10% on either side, on a reduction side or on the increase side, as the case may be. For the title deeds of immovable properties not held in the name of the company, and if in audience we have practitioners from GST, please pardon, because or for that matter, all those who are practitioners of law as well, because one of the challenge which is going to happen in this title deeds is going to be around TDR. Today, the Schedule 3 does not define immobile property, and therefore if one goes to the definition, then an immobile property includes the benefits arising out of land. And TDR is nothing else but a benefit which arises from the land. While under the service tax regime, there was a carve out, under GST, there is none. And if you as an auditors were to say that, TDR constitutes immobile property, you will obviously have one more round of dialogues to happen with the GST consultants who are today representing the clients and trying to defend why TDR is not, obviously the government does not believe that TDR is not immobile property, but obviously there is a huge amount of litigation which is happening around this space. And therefore, the challenge is not just about Schedule 3, but the challenge is also the impact of your disclosure, which will happen in relation to the other laws. Obviously, the questions are going to be about, the items are already known. The other aspect, which is going to be of relevance is obviously when there is a joint holding of such property, or for that matter, there is going to be a challenge around the, the lease aspect. Because today we know that there is a carve out if the lease is in the name of the company and it has been registered. And we have the right of use flowing from 116 also into the categorization of the property. And there is a subtle distinction between the lease and license, right? You have the Transfer of Property Act, which is your section, I think 102 or 105, and then you have section 52 of the Indian Easement Act, which differentiates between the lease and a license. And the question which is going to be interesting is that the agreements may have been called a lease, but in substance it is not a lease. You have, and it may have been, you are in possession, there is a dispute around it. And the question, I guess, is again going to flow, particularly for lease, is that if you show what is a license as a lease, you definitely are showing a part of a interest in an immobile property, because the lease per se means that there is an interest in an immobile property, whereas in case of a license, the easement says that you are merely a licensee. You may have got exclusive possession only, but exclusive possession from the point that, okay, the landlord will not come and walk into your house because it has been given on license, but nonetheless, there is no interest in the premises, whereas in a lease, it definitely means that there is an interest in the immobile property. And again, like TDR, you will have to allow the preparers, you'll have to put questions, and there will have to be obviously a set of deliberations along with the set of lawyers, and you will have to be well equipped to take up a position. And then comes a question that whether is it just merely our working note or is there a disclosure? So that's going to be another set of questions which will arise when it comes to the immobile property. And of course, the joint holding is another aspect, where the things will have to be looked into. I did mention about the capital work in progress and intangibles, and this is going to be, something of interest, because so far, particularly in intangibles, you would never have a project detail. You will only have a broad initiative which the company is taking and a cost attached. Now here they are giving an example of project 1 and project 2. Now what does a project 1 and project 2? Because finally there is a cost, and that cost also has sensitivity before it is released in the public domain. And obviously there are requirements around the aging schedule. I mentioned about the fact that if you have acquired something, then what happens if there is a merger? You would have, whether will you go back to the respective years in which that CWIP was reflected. The question is going to be about completion schedule for overdue and cost overruns. So it was overdue maybe last year, it got extended and there is a new schedule. Will you say that this overdue and cost overrun is with reference to the inception? Is it with reference to overdue and cost overrun as of the first day of the reporting period, or is it the first day of my comparative period? And what is the level of explanation which is going to happen? What happens in many PSUs? We know that there are interim stays are provided. Up to what extent? Because only giving to say that there is a cost overrun and overdue means nothing. One will have to, give little more information, and then up to what granular level will you go? And then obviously the details of the activities suspended will have to be separately given. And then obviously we have the breakup. And what does a temporary suspension mean? Because what you do for Ind AS 16 for your borrowing cost is going to be different from what a generally understood temporary suspended mean. Because if you don't have borrowing cost and therefore you are not capitalizing, and therefore this temporary suspension is not a point which you are viewing. You will only look at the suspension from an angle whether can I capitalize, cannot not capitalize, right? But if you don't have a fund, if you don't have borrowings at all, then again this will have to be one more, because one would have, as an auditing step, one is only looking from a angle of whether is this fairly stated, whether it is going to get closed, and whether is there an impairment or not, right? That is how one was looking at this from an angle if there was no capitalization. But now, irrespective of whether there is capitalization or there is no capitalization, one will have to look at this suspension. Financial ratios. Here, I definitely believe that the government will make some changes, because currently, as we know that the Division 1 and Division 2, which is not NBFCs, do not have the ratios which are applicable for your Division 3, which is your NBFCs. But you do have NBFCs in Division 1. And I thought from a comparative perspective that what is the credit CAR tier 1, tier 2, and the liquidity coverage ratio, I thought is relevant even for whether you are an Ind AS entity or a non-Ind AS entity, but still in the NBFC space. Like today you have so many banks which have got factoring companies which are probably not in the Division 3 zone, but their ratios are equally important even as a factoring company. And I think that Division 1 will see some changes, that for the applicable NBFC related entities, also the same ratios will get borrowed. But broadly speaking, the ratios, the list can be broadly classified in 4 buckets. One is to do with your profitability, one is to do with the liquidity, one is to look at the turnover ratios, and one is to look at solvency. I think these are the 4 broad categories in which the buckets are falling, which is your net profit, return on capital employed, equity, and return on investment. Liquidity is your current ratios on inventory, TR, TP, and net capital, and you have debt service coverage and the debt to equity ratios. And these are the broad categories. Obviously, unless one applies, explains what the numerator and denominator is, it is going to be difficult for people to, understand that what are the components in this. Because historically, you will have in your annual reports covering it at maybe in the information section of the annual report, where they would have given some of the ratios. Some of the companies do explain the components of each of the ratios so that the readers are able to read it. And the question is going to be that for the first time, as an auditor, you are now also saying whether this calculation and the component of each of these ratios, whether they are, in accordance with the understood terminology. And let's take for an example, if you have in some industries, there could be a difference as to how they would be looking at trade receivable, payables, capital goods, non-capital goods, services little differently. In some cases, the net capital may be defined, and we know that, right? For all those who are today, who closely look at even in India's framework, the capital management section, you have a regulatory capital and you have the capital management as given by the management and the components of each of them. But take an example that you find that what the company in March 21 has probably reported under each of or some of these ratios in their annual report, and what you are giving is probably at disjoint with what they have given. How does whether you convince the reporting enterprise to say as to why it is there is a difference of view, or they convince you why you as an auditor needs to supplement this maybe by way of a note. This is going to be another tug of war, if I may say so, where it is not just about giving the ratios, but also to look at what is the report if the company has given in the preceding year, and whether is it in consonance or is there a variation. Obviously for 22, the change is something which is not going to be applicable, because you're not going to probably, there is a different thought that whether will you go back and compute or will you only give this year's ratios. Obviously the transparency means that on the previous year you will do it, but obviously between the 2 years there could have been a lot of changes, mergers, demergers, and therefore again this is going to be a section by itself, and a lot of work is going to in my opinion that is going to happen. And in specific also for division 3, I will definitely would like to also share that today you have Basel 2 and Basel 3, and you have the liquidity coverage ratios. And in the liquidity coverage ratios, as we know that one of the fundamental point on a liquidity coverage ratio is the quality of the asset within a 30 days period which you have, which will ensure that when your liabilities within a 30 days are due, whether that asset is capable of getting realized. Now, there are obviously different stress factors which the RBI is coming out since 2019. They've given a roadmap from December 20 to December 24, and there is a difference between the the type 3, type 4 based upon the limits. And also it is going to be very interesting that those reference points are given with reference to December, whereas in cases of NBFCs which are following other than December accounting year, it will be interesting to see that how they are showing that liquidity coverage ratio with reference to the December 20 and what is going to move forward. I mean, like if the government's intention of equipping the readers with high quality information has to match, then the level of information and the place at which it is going to be given is going to play a great role. I may have to hurry up a little bit, so please stay with me on this part of my point. Obviously, I did mention in all the 4 aspects, and therefore it is going to be important that while the CRA most of the companies, when they give credit rating, they always give what does the credit rating mean in terms of, so that people are able to appreciate what that credit rating is. And I'm sure we will see a little more around the what is the tier 1, how much can it not be greater than tier 2, or what is the minimum size it can have, what is the composition. I think it is going to be interesting to see the disclosure around the entire credit asset ratio or the credit risk weighted asset ratios, and there will be differences between sometimes the NHB has a different view, RBI has a different view as a regulator. So it's going to be very, very interesting to look at this part of the ratios and its explanation. Closed group related, I mean, like, this is something which is obviously the promoter shareholding, and we know that currently the promoter shareholding has a reference to go back to section 2 subsection subclause 69, which defines a promoter. And it is always going to be interesting to say that whether the companies regularly are updating their change in promoters, because normally subscribers are deemed to be promoters, and they would have over the period of time they would have probably been promoters, and therefore you have those MGT 10 forms which will have to be filed, whose reference will have to be taken, because annual return is one more section from where the promoters listing is happening, apart from the listed space. But for an unlisted space, it is going to be important to look at this part of the the changes. How are they happening with the MCA, and what happens if the MG10 is filed subsequent to the reporting period? Will you take that into cognizance? Will you not take into cognizance? Currently, barring it was only the secretarial audit which was looking at the promoters. But now this is one more addition to your checklist, that who are these promoters, and what happens if there is a change in promoter shareholding subsequent to the year end, and they're saying that this change got effected in the earlier period. So one will have to also factor that it's not just about the year-end reporting. You are on the cycle right till the time you have signed your audit report. So it's a moving target in many respects, and we will see as to why this moving target is happening in the other aspect as well also. And obviously this is, this was always part of our related party, so I'm not really looking at it. So you have the promoter, the number of shares, the percentage, and the percentage change during the year. And the question which is going to happen is that if there is a opening, there is a buy, there is a sell, and again a buy and a sell, and then a closing balance, how is this change is going to get reflected? Will you say opening at any point of time? These are all matters which are going to get evolved and which will have to be standardized by the auditing fraternity, so that there is no confusion for the team members as to how you are collecting information and how are you going to present that information. Obviously, it is going to be another interesting aspect, because SEBI obviously is also moving away from the concept of the promoter to promote from the controlled entity. So it's going to be interesting that as SEBI changes its stance around the one is about the declassification aspect. Obviously, for the promoters, the declassification rules are there, but there is also a big thinking around those companies, and rightfully SEBI is thinking on those lines as well. And so this is going to also play an interwoven, in many situations. If we are going to look at about obviously the promoters, the repayable on demand or without specifying any terms or period, I guess this is something which is obviously clause 32 was there, your 185, 186 was there. So I guess that's not a kind of a big challenge here. But when it comes to the aspect on the control on fund movement, right? So they have spoken about the utilization funds, borrowing from banks or financial institutions, and company declared as a willful defaulter. Now I'll take the last point first, because this is a big pain point. When there is because they've used the word any other. Now banks and financial institution, RBI has already laid down fair circular around what does a willful defaulter mean. And here again, I was mentioning about the fact that why there is a moving target. The willful defaulter was not declared up on the reporting period, but was declared between the reporting period to the date of audit report. Obviously, one will have to constantly keep check on these developments which are happening. The questions which are going to happen around this is that if there is a dispute, that why would, when for the other category, willful defaulter is not defined, only because a creditor has not been paid and they have taken some steps, or they have taken some steps to write to the, maybe in terms of, in some cases, about the forums. In some cases, it can be Mahara, it can be, in some cases, it can be in other areas, or for that matter, the industry forums. The question is going to be, how will we take willful defaulter definition for the purposes of borrowing from other than bank or financial institution? Again, no easy answer, and each of these sessions and the efforts which the chamber and the other professional bodies are taking is only with a view to refine, and if necessary, go back to the MCA with a request that if they can clarify and give a workable question so that both the preparers and auditors are capable of complying. And I applaud the chamber, that each of such sessions are going to be food for thought, resulting into a clarity of answer, or resulting into representation to the regulators with the correct point as to why they need to either give more more information, or they need to change what the request which they are making through such schedules. So obviously, the utilization of funds is going to be that there is somebody who's lending with a guarantee or a security. It can be a company, intermediary, and ultimate beneficiary, and understanding in writing or otherwise that you will use for whatever. Now take a practical example. You have an ECB from your parent. I'm sure they may be the UBO, if that is what has been disclosed, or the ultimate UBO which you have filed under the Companies Act with the MCA, or for that matter, how they have otherwise defined an UBO. Obviously, there is a underlying investment or a funding. So you are setting up a third-party manufacturing facility with the help of the ECB. Today, if we look at the words, technically, what they are trying to understand, that who's the person who behind this screen is controlling. But the way we look at it today, it will throw a different set of challenge. Do I have some questions? I think again I have Ajit or somebody who's raising. If I need to stop for a minute in case. Tejas, do I have a question from Ajit and somebody?
Sandeep, you may decide to take question at appropriate time. If now or maybe at the end, whatever is your choice.
Okay, sorry, I am not looking at the questions. I'm looking at my slides. So if members can bear with me, maybe I can just quickly move forward, unless they can speak in case I have an error in what I'm presenting. Then I would love to get myself corrected in case I'm speaking something which is not the position.
I will take care in the end, I think.
Okay. So therefore, obviously, it's looking at the date and the amount of the funds, advance loans invested in intermediary or by the intermediaries, details of each intermediary, ultimate beneficiary, details of guarantee and declaration of compliance with FEMA, Companies Act and PMLA. Now, prevention of money laundering is a specialized subject by itself. It's like, how many dependent professionals are going to be there around each of the point to say that they have complied with FEMA. So take an example today. In case of a company, if there is some kind of inquiry which is happening by the enforcement directorate, no aspirations have been cast, but there is an investigation which is happening. Now, if we look at the master circular under FEMA, your right of automatic remittance goes away because the company is being investigated by a regulator and you have remitted money. Or I'm just giving examples today that where is the, what is the potential danger of each of those sentences, whether the company has complied with or not, because today it is flowing into realms of, subjects on which the auditor is not supposed to be an expert. Companies Act, we understand. Accounting standards, obviously they are supposed to be our forte. There cannot be any two opinions around it. But to say FEMA, PMLA, and with the kind of litigation and with the kind of perspective and over-evolving law, it's going to be, this is going to be a kind of a big deliberation in terms of who these ultimate beneficiaries are, and if the beneficiaries in terms of what has been filed with the Companies Act, because you have a different threshold for 10% and different threshold for 25%. So while the law was talking about 25%, the act, the rules spoke about 10%. The question is going to be that what is the guidance in which one will draw that who these ultimate beneficiaries are. Obviously, this is something which every banks and financial institutions are concerned that whether they're not used for a specific purpose, and if they are secured by the current assets, whether the reconciliation of quarterly return statement with books and reason for material discrepancy. The first part obviously justifiable, but the second part also, which is going to be of very interest, is that the amendment does not say that whose current asset. So I can have I can be a borrower on a third party or a group company asset, and because those assets are not my books, they are obviously in the books of the person who has given the current assets for the purposes of a borrowing facility by non-owner. How this reconciliation is going to happen with reference to the quarterly statements, and it has to be reconciled with the books of the person who owns. Now, this is going to be another set of a dialogue, that whether the company is going to be in a position to enforce and give you the information around the the current assets. There are more than one group companies which may have been using these facilities. How is this reconciliation and discrepancy between, because facilities are in my name, assets are in somebody else's name. It's going to be very, very interesting to see as to how this part of the compliance is going to happen in terms of the quarterly returns. Another aspect, even if I don't look at the third party asset, the other aspect which is going to be of interest is that today you have a quarterly submission, you have a receivable, and there are, the cash management systems are there. Sometimes there are direct check deposits, and many a times the information of the customers who has paid you this money is not available by the time the quarterly returns are submitted to the bank. So as of that date, those credits were lying in suspense or were subject matter of adjustment against the customer. Subsequently, the credits are identified and posted to the relevant customers. Obviously, this is going to happen on the date on which the money has come and not on the date on which it is matched, unless the systems don't permit you to do the even matching for an earlier period, because this is going to be matching of receivables against the payment credit. Is this a discrepancy? Of course, it's a discrepancy, because how you have reflected those credits is going to be as to how the company has chosen to disclose the trade receivables. I think, from a perspective of the listeners, I would believe that each of these sections must be time tested as the quarters are getting close, because it will only help us improve and understand what. See, when we do a quarterly listed entity, these are not matters which you look at it, you only look at it from a perspective of your overall collections and balance sheets, obviously, but not from a reconciliation perspective. Now what is going to happen is that one will have to extend also such understanding, may not necessarily be with our listed LRR, but maybe immediately thereafter. But it is going to be important for the auditors to get equipped for this area as well. And if this is going to lead to some kind of a discussion, dialogue, reporting, one will have to also be mindful that this, unless it is discussed, deliberated, reporting is something which is a certainty, but understanding and allowing the companies also that in their ignorance, it should not happen that you have a reason for a discrepancy. And this material discrepancy is again a kind of a very, very subjective materiality level. What is a material discrepancy is also a subject matter of big discussion. We've spoken about the as willful and details of default. Obviously, the compliance with laws and disclosures, the NOCLAR is already there, and that's something which is obviously going on. But specifically in this particular case is about the scheme of arrangement. And this is again a very interesting space, that while many a times we know that the certificates have to necessarily mention whether the treatment is going to be in accordance with the accounting standards or not, but many a times the certificates are, and the companies in their scheme will say that the accounting will be in accordance with the applicable accounting standards, and therefore they have not spelled out clearly that what are those compliances which they are going to do. And therefore, as auditors, because they have said that this is going to be only will be accounted in accordance with the scheme, the auditors will also say that based upon the scheme, it is not providing anything which is contrary to the accounting standard. But the question is going to be around the old schemes which are getting approved in the subsequent period, whether those are arrangements have been there or not. And this is again a matter of big deliberation, that court is the superior authority which overrides all the acts, and therefore the accounting standards as well. And this is a constant friction which will obviously have to be resolved even while in this part of the disclosure. Number of layers is not very difficult. Disclosure about as far as the CSR is concerned, so just quickly on the slides, the effect and the deviations as far as the layers are concerned, they are looking only for name and CIN numbers and the extent of in the downstream companies. As far as the CSR is concerned, I think the only question which is going to happen is about the total of previous year's shortfall. Now, as we know that while the MCA and the regulators always felt that if there was a shortfall against the mandated percentage, you had to explain the reasons, but there was really no need for you to provide for the liability unless there was a contractual obligation to provide for the fund, in which event obviously there was the provision and provision did kick in. And the question which is going to happen is that whether total of previous year's shortfall, in my opinion, will not go back to the period prior to the when it was still voluntary, but it can still be subject matter of discussion and dialogue, and the questions which are going to happen, that if one takes up a strict view about the reasons for shortfall. Now, whether mandated or non-mandated, that can also be a point. So interesting as far as this CSR portion is concerned. Some other changes are in relation to the presentation and additional disclosures, and here specifically on the presentation, as we have seen that your pre-amendment, your PPE, tangible, intangible, and now you have the all the three items. That's only as far as the words are concerned. Long-term borrowings are now getting classified under short-term borrowings. Security deposits are obviously under the other current assets. As far as the in division 2 is concerned, the changes are obviously about the prior period errors or restated of the opening balances, other challenges. Lease liability, this was a matter of a big discussion, because in many cases, whether it is a financial liability or non-financial liability, because in India and internationally, there were situations where if you chose to reflect it as a financial liability, and if there was a covenant that your financial ratios will not, you will not borrow, or your ratios will not go beyond a certain threshold, which would result into either a derating or a recall or a recalculation of the debts. That was a big dispute as to whether what is the classification, and therefore in absence, and Ind AS 116 did not really have any info guidance because obviously there is no structure under the IFRS arena. What is going to be interesting dialogue here is that now obviously it is going to get your previous year's figures are going to get restated. Now, one of the fundamental point, interesting question though, which is coming up in the Ind AS framework, is that we know that under Ind AS 1 or para 41, your restatement is technically you go back to the opening balance sheet. You cannot just merely restate your numbers. You cannot just reclassify, because it triggers restatement of accounts. Reclassification, as we generally understand. In my opinion, while the para 41 disclosure can be made, in my personal view, I will not take the view that this is equal to restatement of the financial statements, because there is some support which we can draw from the Schedule 3 opening paragraphs, that if there is a change on account of an amendment, then that change will be carried out. And I would believe that it would be, reading the para 41, I would believe that it would be not in the spirit, but is there a merit and is there an argument? By all means, there is an argument around the Ind AS 1 para 41, and it is going to be interesting argument, interesting to see as to how the practitioners evolve this area as well. And rest are in terms of the security deposits, where they are wanting to now clarify a little more. Some of these practices were already there, so I believe that it is not much of a challenge, but lease is certainly a kind of a challenge, because while for cash flow purposes, it was definitely required to be shown from the financing. So on that, there was really no two opinions, but now on the presentation, this is certainly, the covenants is something which is going to be interesting. Presentation related, as we know that only for Section 8 companies, there is definitely the grants and donations is something which they are wanting to break up in Division 1, revenue and other income. Obviously, the rounding off is not something which I may want to look at. Registration of charge or satisfaction, either side, where it is not registered or where it was supposed to be satisfied but not satisfied, I don't see that as a challenge. Crypto is another area, which is going to throw interesting challenge. As we know that the question is centering around that whether for trade or invested, and then what is the profit or loss on the crypto, and whether have you received the advance for crypto. So the third category is very simple. I think it will be true for those who are intermediaries, the brokers who are today, facilitating the money and the crypto or the Bitcoins. So third part is not very difficult, but what is going to be interesting is that I can have a crypto which I have bought, let's say, for the purposes of not trading. The fact of the matter, I have purchased, which means I've invested. It is not with a view of capital appreciation or for the purposes of trading. The question is that have you invested? And the answer is yes, you have invested because that money is bought. Now I've bought something for $20,000 and I use it in settlement for a liability when the value was 25,000. Obviously, there is a 5,000 gain. Now, I may have chosen as a reporting enterprise to adjust that 5,000 to my consumption or to my expense, and not necessarily use it for the purposes to say that on settlement it caused a gain. And the question is that it is not reflected as a profit or loss for sure. The question is that whether this requirement will force the reporting enterprise to say that if there was a gain or a loss on any transaction during the year, whether in which line item and what quantum is sitting is going to be a matter of a conversation. The other aspect obviously is what Schedule 3 divisions do not deal with in their presentation changes is the category under which this crypto will get recorded. And as we know that the tentative agenda decision of 2019, as far as the IFRS, as far as the ISB is concerned, they have got a TED, they have yet not finalized it. They have considered all the four aspects, whether it's an intangible, whether it's a financial instrument, whether is it a cash equivalent, whether is it an inventory. And again, it is going to be interesting at this particular point of time. The ASB has not come up with the guidance in terms of how and where should it be reflected, whether as intangible or as inventory or some other classification. And it is going to be interesting that where will this get classified? And maybe this could be a matter of representation, because if they wanted this gain or loss, I would have believed that the regulator should have also amended and put where the disclosure will happen. So this is going to be interesting, to follow and amongst professional circles to deliberate this aspect. Obviously, on the undisclosed income, this is going to be a big kind of a question between the tax practitioners, and in some cases you are not entitled to credit the income which has been disclosed, because that is what has been agreed with the tax officials, and therefore you only have a tax outflow. And the question is going to be as to how those disclosures will happen. Binami property is a subject by itself. Who are the beneficiaries and what actions have been taken. Struck off companies is another. What is the name of the company, nature of transactions, balance outstanding and relationship. Some of these practical challenges, the company was struck off during the year and got restored subsequent to the reporting period, or was not struck off on the reporting period but was struck off before you signed up. So what will happen is that the level of information which is going to be required for your financial reporting to be right on the date of your audit report is going to be, so your after event balance sheets is something which will have to be so robust, and the company will have to be so robust that they are constantly keeping track of the companies. And we know that the companies which are restored are not necessarily updated on the MCA record. So your MCA records will be your the final authority, but some company will give you the NCLT order to say that our company has got restored. So there is going to be a kind of an issue. So if I was to summarize the division 1, 2, 3, the way forward is proactive engagement with the management, look at the comparative aspects, look at what is the increased scope of work, the team, the clarity, obviously resulting into additional scope and fees, and therefore the revised guidance notes as they come out, and the accounting software update is what I believe are some of the matters which are to do with the schedule 1, 2, 3. I was given time until 8, but I still have maybe another 10-15 minutes. If you can, Tejas, if you may permit me to take the CARO as well, I should be able to finish this in 15 minutes.
Sure, sir. Sure, sir.
Thank you. If anybody would like to get a quick cup of tea, coffee, I can probably take a break or I can continue. Tejas, please advise.
So you can carry on. You can take a break if you want, but
no, I'm okay. I'm okay. All right.
So no problem. Yeah.
All right. Thank you. So obviously, the applicability of CARO is something which I'm not wanting to look for. Obviously, compared to 16, there are only new clauses. As far as CFS is concerned, your 21 is the new clause, and then from financial year 21, that was the amendment, which and the clarification which they brought out very clearly. So obviously, what has happened? What are the key changes of CARO? So there are obviously CARO 16 had 16 clauses, 7 new have come up, 1 has got merged and 1 has got deleted. So your score count is 21. And what are some of the new clauses? You have the disclosure of transactions not recorded in books, and we saw an interplay between your Schedule 3 amendment and in terms of the CARO. Internal audit system is one pass. Cash losses is another aspect. Resignation of statutory auditor, which is new, but I don't really believe that there is a big change, because this is the reasons and are fairly well in last 1 year are fairly taken over. Opinion on liquidity, I would like to share some thoughts around that. Something around CSR and CFS. Some thoughts around CFS as well. The merged is about the IPO plus preferential allotment. Logically, it came into the one, and managerial remuneration is something which they deleted because they knew that the compliance in any event was happening. So this is a brief, obviously for all the authors, this is not, they've gone through all this. So it's mainly for the non-authors, right? As far as the PP and intangible assets are concerned, again, linking between the TDR and in whose title deeds they are not in the name of the company. Obviously, the registered valuer is your answer. Binami property, again, about the new and pending proceeding in respect of Binami properties in the financial statements. Again, I think the view which will be taken there is the view which will have to be taken in auditors, and whatever view you take as in your auditing steps is what you will ask the company to take. So I guess, it's going to be an egg and chicken. So rather than wait for the preparer to, come back and say that this is the position I'm taking, I think it is important that at our level itself, we frame our the steps, and I think it will be very interesting for all those who quickly will, I presume, will buy the books, where the authors have, penned their thoughts and a way forward. So I believe that to a great extent, my work for these slides with this, with this launch of the book has been made extremely easy. So I'm just going to share thoughts around some of the the questions which I think is going to be relevant from an auditing perspective, and most likely, considering the the expertise of the authors, they would have also covered it. I have not read it, so I'm not in a position to today comment on that, but I'm sure you have great authors. So the aspect around the inventory, in my opinion, is going to, because it's obviously for each class, and there is going to be some practical challenges in at least 2 scenarios. One scenario is where you do not have the records for issue, because the matters are such that you have opening, you have purchases, your physical inventory, and rest is your consumption. And consumption will include your wastages on the positive or surplus, as the case may be. And the question is going to be as to how will this part of the reporting happen? Because if you say that there is no record, it has a negative connotation. If you say that this is the method, then comes a question. You still have to say as to why the discrepancies are not being reported up. So I would believe that there will have to be understanding, good choice of word, which gives out a balanced view. And many a times it is possible in a perpetual inventory that there is a regular updation of the surplus or shortage as at periodical intervals. And therefore, because finally we have to aggregate with reference to the inventory on 2 periods, it is going to be interesting to look at as to how this 10% also is getting computed from the various system which is going to get available. Because it's not necessarily a year-end exercise. And obviously, this 10% has to be value and can't be necessarily in terms of quantity. I would probably believe that that would be a fair aspect. And obviously, the impact of this, the linkage point is about your discrepancy in the quarterly statement as far as the working capital aspects are concerned, right? So there is going to be, batting and bowling between the 2 aspects. As far as the loans, guarantees and securities are concerned, obviously it has expanded the scope for sure. There's no doubt about it. From the aspect of, I would say the checklist for each of these items is going to be important. I think that is because this will require a great amount of ifs and buts under each of the sections. The aggregate disclosures obviously are about the closing balances, the evergreening. Now, this is something, very nice conceptually, but to be able to ensure, and we are all, wiser in hindsight. Let me admit that, all of us are wiser in hindsight. And this is an area which you have to deal, on a real-time basis. And therefore, the questions which are going to come around, that what is the robustness of the granting of loans, the period from where the money is coming, the traceability of X, Y to Z, eventually at some point of time in one of the professional deliberations, the question somebody was asking, does it mean that we are going to do 24/7 audit? And I'm not surprised that the manner in which the whole things are being asked is virtually that you are on your the roller coaster 24/7, because for a large size companies or even for a small size company, for a mid-sized company, each of these are going to pose a question, that because not everywhere you will find that. See, IFCR is one part of it for to all those to whom it applies. But otherwise, how are you going to be in a position to say that you have documentary evidence as to the applications, the purpose, the new set, the existing relationship? And there is going to be, so much of reliance on the company's internal control, and those internal controls will have to be tested throughout the period and will have to be extended in some of these areas, is what I feel is this particular paragraph is going to, look at. Fortunately, the guidance note on CARO has given some amount of, the formatting. As far as the deposits are concerned, obviously the, what are deemed to be the deposits and these questions which are obviously arises in all cases beyond 365 days, and whether customer has claimed, not claimed, whether are you returning, are you not returning. I'm like, I would believe that this is something which is run through fairly. GST is another aspect, all unpaid statutory dues. I'm not wanting to look at this aspect. I have mentioned that what they have said is only exclusion where there is the amnesty has been provided from disclosure, but there are also cases where under arrangement you are not entitled to bring back those assets into book or capitalize those assets back into the books and only have a tax outflow. So again, it is going to be interesting to see as to how will this run through. I may want to, those who are referring to the AASB CARO guidance note, currently there is a reference to section 158 BD, but now as we know that up to March 21, you have now section 153A to D, and now obviously after 1st April, the 147, 148, 149. So, the framework has changed. So to that extent, those who probably read the guidance note may have to just look at the change in framework on account of the changes in law around this entire disclosure. As far as defaults in repayments of loan are concerned, here it is obviously has been extended to any lender, and obviously what does it require? The report plus usage plus amount and nature as far as the short term for long term, and details and report if defaulted in repayment. And this is going to be interesting because many times whether you are a trade supplier or you are a lender in capital goods, because as we know that under the ECB guidelines, you have the trade credits also are treated as ECBs, and you can have a pure ECB loan. And again, it is going to be interesting in terms of this aspect, that what is the definition of lender. And we also know that the general defense the companies always take is that do you have the money lender's license, and most of the time it may not be available, and therefore the definition of a lender is going to be important. Preferential allotment is what they have covered, so I'm not going to take that. Fraud reporting is something which is obviously has been a matter of dialogue for last 3 years. Obviously, it was restricted to employees or officers, and now they've removed these words, and it technically means that fraud is a very great connotation. I hire somebody for a price with a view to get benefit. Technically, it is also a fraud. I am expected to give 18 karat or 18 touch gold. It is not 18, it is 16. Technically, somebody can say it's a fraud. Now, these are going to be extremely interesting aspects to see. A transporter who deliberately gives you only 98% or 99% of the material and takes away 1% for his en route, the dhaba food. Is it not a fraud? It is a fraud. And the questions which are going to arise is as to how, to what extent will this also get addressed. And today I'm, in this evening, I'm not wanting to say that this is right or this is wrong, because we are dealing with the generic word, and the generic word has to get translated into reporting an amount. And therefore, at what stage, whether is merely a suspicion of fraud, whether does it have to be proved as a fraud, is there a police complaint only a basis on which a fraud is being organized? So there can be so many variations by their removing the word officers and employees. And as we know that today, as far as NBFCs were concerned, shortage of 10,000, RBI had said that for that you will report. I mean, they were very, very clear that whether it is fraud or it is not fraud, we are not getting into it. But we want that reporting to happen, because coloring of that, we will come to a second stage. Here, one will have to satisfy that whether is it in nature of a fraud or not. And if you say it is in nature of a fraud, then all logical expansion steps follow. And if you say it is not fraud, you will have to also have a valid reasons to say why it is not fraud. Nidhi company, I'm wanting to avoid. Internal audit system is something, obviously, we know they are now obviously saying whether are you mandatorily required under section 138 or you're not mandatorily required. But I guess it's a welcome move. Registration with RBI was always there in their CARO. The additional reporting is about the fact that without a valid COR and whether are you a CIC, and whether how many CICs are in a group is also well defined by RBI. So I don't really see that as a kind of a challenge. But yes, this CIC, whether it continues to fulfill the criteria applicable to it or not, and this is going to be for CICs exempt where 60% and 90%, and there are sometimes those questions are coming up that in that 10% what constitutes money market instrument, and in some cases in 10% you have taken up a premises which is not used by the company, and technically RBI is of the view that you cannot have the 10% bucket for investment. You buy a property, it has to be for your self-use, and therefore there is going to be greater level of I would say knowledge, competency and issues, particularly when you are saying whether it continues to fulfill the criteria applicable, and whether the criteria applicable is only at the year end, whether the applicability is throughout the year. What happens if you have breached your 60% or 90% during the part of the year and it got covered up the next day? These questions are posing questions, and answers will have to be sought through. Reporting on losses, obviously this 16 was not there. It was there in 16, got dropped and again got reduced. So I think it's just a refreshing one's memory. Resignation is something which is fairly stable. Opinion on liquidity, here I have some kind of a challenge, right? So take an example. I'm the component auditor, and I have reliance on my parent company. And I obviously SA 560 as and the going concern is a big it's one of the most critical standards on auditing. And I have to obviously adopt and close my audit prior to the parent company, because parent company has to consolidate my numbers. And on consolidation, let's say that I have banked upon the parent company at that particular historical last year, no challenge, the letter of support, funding, anything and everything which I need, everything is checking the box. But when the console or the parent company's audit is over, because of some component, other audits, there is some kind of an uncertainty around that parent. I definitely have a challenge, and the question is going to be that whether am I expected to revise my report? No answers, but I would leave the point for my professional colleagues here and listeners here to be able to see that there is a kind of a challenge on this liquidity, because there are specific pointed. And today, as auditors, so far, when it comes to LLP, we are countersigning a certificate of solvency which the management is given. Here, there is some kind of an affirmative view, because finally CARO audit report is a part and parcel of our audit opinion. And one will have to be extremely careful in this area, because it can be fraught with litigation, it can be fraught with some uncertainty, and I will not take this clause with that ease as I would. Maybe in some other cases, not that you take in anywhere, but this for certainly not. And then obviously the unspent amount, and we know that this is going to be one another challenge, that while the lot of representation has happened that during this second lockdown, many companies have not been able to open up the second special account for transferring the funds. There have been a lot of representation, and there is going to be interesting to see what is the for the non project or the ongoing, other than the ongoing project. It is going to be interesting that for all those who have opened the bank account beyond the stipulated period, whether the government will come up with the extension while the time has already passed. But it will be interesting to see this entire CSR compliance. CFS is the point where materiality, if the component auditor has reported something in this area, qualification or adverse remark, I think for rest of the items, the materiality can be at the parent level. In this, we will not be able to substitute the qualification adverse with reference to the size of the company, and therefore one might have to reproduce the remark of the component auditor. So in conclusion, the effects of CARO 2020 is, whichever box we pick up, modification of audit procedures, increased reporting responsibility, increased focus on reporting of loans, specific assertions which were covered in audit, indicators of poor financial position, expectation of stakeholders. I think whichever way we juggle this parcel, but the effect of CARO 2020 coupled with Schedule 3 amendment is some in substance is, if I was to use the words of UNESCO, it is not the answer that enlightens, but the question. And we hope that this evening presentation, I've been able to probably, if not been able to give answers, but at least I've been able to pose a question, so that collectively, as all professionals put together, we are able to find the correct answer, so that the profession at large continues to remain the most sought after profession. Thank you so much.
Thank you, sir. There are some couple of raising of hands. I will, Ajit Mr. Ajit Sutharia, you raised the hand. You can unmute and answer. Percy, I've unmuted you.
Yeah. Thank you, Tejas. At the outset, I thank the Chamber for giving me an opportunity to speak. Well, I've got two questions, Sandeep bhai. The first question is regarding, there's a clause on revaluation of property, plant and equipment or intangibles. Where the change is more than 10%, you have to disclose that the nature of the amount of change. Does it also apply to impairment? I'm not carrying out a revaluation model, but I'm carrying out a cost model, and at every reporting date, I'm carrying out an impairment analysis. There's a triggering factor and there's an impairment analysis. And the change, the decrease in the carrying value is more than 10%. So does this clause become applicable? That is question number one. And question number two is the CSR liability for FY 21-22. I have a listed company. I calculate my CSR obligation as on 1st April 21. It's not an ongoing project. So do I have to allocate it over a period of 4 quarters? Or should I should I accrue for the CSR liability only at the end of 31st March 22?
Okay. So I'm going to first take shelter of the Institute's FAQ. So a purist thinking, so as we say, right, in the accounting profession, or when we are examining the law, there can be a purist thinking, and there can be finally saying that you have a time, and therefore the liability does not accrue on the day one. As far as the FAQ is concerned, what it is obviously not in so many words, but it is hinting to say that if one has a full 12 months, and therefore it need not be at the first day. It's not saying that it need not be, but in conclusion, it would mean that it is not the first part. There is a varied practice which is happening, that if I have a liability is there, and I have a time to spend. There is a difference between time to spend versus an obligation which is there at the day one. So there are companies which is obviously which is not right to say I will divide by 4, because there is no scientific method for that, right? So either I say that either there is liability on day one as a purist, I therefore only debit the spendings to my liability account, or I debit what I've spent and then at the year end have the shortfall. I think there can be many of the practitioners, in my opinion, will take the FAQ, but I will not be surprised that there are purists as well. And
So the FAQ is, it is at the end of the financial year. So you accrue for the liability as at the end of 31st March 22, right?
That is if we look at all the questions, one of the answers will lead to that point.
Yeah. And the first question was,
as far as your CWIP is concerned, no, that is not the revaluation, because CWIP.
No, I'm not referring. No, I'm not referring to CWIP. I'm referring to property. Or intangible
anything.
assets.
I'm not even CWIP. I'm saying for that matter, and the entire PPE or intangibles where the impairment is happening, that is not revaluation, because what this question they are asking, because those disclosure for impairment has a very detailed disclosure. And it entirely suffices the purpose. But what it does not do is it does not have a contrary standard which they are trying to achieve through this revaluation model. So in my opinion, I would believe that your impairment is not what this clause is covering.
Okay, and sir, the last question, whistleblower complaints and CARO whistleblower complaints, whether the auditor has considered the whistleblower complaints, if any, received by the company. Now, how will the auditor get an assurance from the management or those charged with governance that he has received all the whistleblower complaints that he has considered, that he has received all the whistleblower complaints that were received by the company? Company may not share some whistleblower complaints. How to then come to a conclusion that the company has shared all whistleblower complaints and therefore the audit has considered it for reporting purpose?
So I will address this from two angles. While professional skepticism is there, but I will not start with distrust, because whistleblower is only a small element of various information which we are supposed to get from the management. And so therefore, I will not start with the fact that there is a distrust with which I begin. Because the day we begin with distrust, that means my every audit will have to have a distrust. And therefore, what one will have to look for is that what is the mechanism set by the company for whistleblower in an unlisted space. I think we need to distinguish between, because what happens is in a listed space, this is something which is already known. I mean, like there is something where robust systems are in place, and therefore the matters are available. There are beyond owners, there are direct access to the chairman, and now your chairman is split between the operating and non-operating, and therefore I would believe that the big concern is around the unlisted space where the owners may not necessarily have formed, right? So there are going to be, in cases where there are human resource department, where there may be some complaints around unfair treatment. So there is going to be more challenge, I believe, is going to be owner managed unlisted space, where this clause will apply, because there is no exemption, right? So the big point with CARO is, except for those to whom it is is excluded, whether with CARO I am hitting an ant or I am hitting an elephant. In both the cases, my ammunition is equal. So so I'm using a cannon to hit a ant. So yeah, but I will look at process, and I will look at, and I will a dialogue is something which will be healthy in my opinion.
Thank you, sir. Thank you very much.
So we can take one question. It's fine. So we can take one question.
Yes, please.
Yeah. So in case
If the listeners have some capacity, I can give answer.
yeah, so I think one question is that if component audits are not over on the date of finalization of standalone audit, then how to report on CFS clause in standalone financial statement? This is by Mr. Rajesh Nakar, who has posted this question.
No. So if there is a consolidation for an accounts which are based currently on management accounts, and which are and whose audit is not yet over, correct? And and therefore, if the company is willing, and they will have to take this as a fact. So you have a CFS consolidation procedure as to whether it's a material subsidiary, not a material subsidiary, and in absence of that, you will have to report this as a fact.
Yeah.
But if it is material, then not having this is out of question.
Yeah. And last is by Rajesh Shirshad, that in case of a builder's CWIP year-to-year basis reported is based on the expenditure incurred for the period first year and second year to third year, and when part of flat sold based on completion basis, then how to report CWIP figures when revenue on a percentage completion basis?
Yeah, but I think this question, because obviously in a real estate developer, it is not a capital work in progress. So
Yeah.
it's an inventory in their hand, and therefore this question should not survive in the hands of a real estate developer.
Yeah.
That should not survive.
Yeah. And whether will unbilled dues include fees like audit fees which are provided for but bill is raised in next year? Mainly the issue is about the provision of expenditure.
Technically, if those are contractually known, then you know.
Yeah. And last question was, are there any differences in disclosure for small companies?
Except for exclusion?
Yeah.